Welcome back to Investing Assist. In my last video, we looked at 3 ways that you could make $1,000 fast. If you haven't already, be sure to go check out that video. In my past few videos, we've looked at the basics. So, why do people invest? What are the benefits to doing so? Today, we're going to take it a step further and look at where you can actually put your money. There are so many places to invest your money, but today we're going to look at 3 basic investment vehicles: stocks, bonds, and mutual funds. So, getting it kicked off here with stock. There are 2 main types of stock: common stock and preferred stock. More people are familiar with common stock. One of the main differences between the two is that with common stock, shareholders have voting rights in the company. These voting rights include things like voting in the elections for board of directors or things that will directly affect their stock ownership, like stock splits or merger proposals. While preferred shares aren't going to have the same voting rights as common stock, they do, however, have a priority to company income. So preferred shareholders are going to get dividends paid out to them before common shareholders. Also, in the event of a company's dissolution, preferred shareholders have a right to any potential distributions over common shareholders. So now that I've kind of gone over the difference between the two, I really want to take some time to focus on common stock because that's what everyone's more familiar with and it's what's traded more often. So when you hear people ask questions like, what company should I invest in? They're referring to that company's common stock. And just like any investment, there are pros and cons to common stock. One pro we touched on earlier was voting rights. Another thing is that common shareholders are going to tend to have the highest rate of return in the long run, so growth. Common stock is also going to tend to have a higher rate of return than bonds, which we'll cover here in a minute. A big con of common stock, however, is that there's no guarantee that your investment is going to grow. This is why it is especially important to research companies beforehand and know what you're buying. I'm planning on doing a video sometime soon about what I look for when I research companies. Let's move on to bonds. Bonds can be a great option for conservative investors, maybe with a shorter time horizon to invest. Early on in an investor's life, it's common to see more stock in their portfolio when compared to bonds. However, as we grow closer to retirement, you may see a shift to more bonds in the portfolio. Why is that? It's really quite simple, but bonds are considered a safer investment when it comes to protecting your principal or what you've put in. For example, looking at a big market correction like we just had due to coronavirus. For a younger investor, they still have time on their side to make up those losses. An older investor might not have that opportunity. Hence, as they grow older, they may tend to have more conservative things in their portfolio. One of the biggest drawbacks to bonds, however, is their low rate of return. Now, you can still most likely get more than a savings account, but it's not going to be, more often than not, the same return that you would get in, say, common stock. Moving on to the last investment vehicle that we're going to talk about today, mutual funds. Mutual funds are open-end and professionally managed investment funds that are made by pooling money together from several investors and purchasing securities. Now, since they are professionally managed, they aren't free. Fees tend to range about 1% to 3%, and some people are fine with this because they like the idea of having their investments managed by a professional. On the flip side, there are some non-professionals that are able to notch higher returns than the professionals on any given year in the stock market. This has really turned some people off from mutual funds. I actually saw an experiment where people literally just threw darts at different investments that were posted on the wall. They ended up choosing those investments and they ended up outperforming the more touted options by the professionals. So ultimately, it's going to be up to you, but mutual funds will have a fee. So there you have 3 of the most common types of investment vehicles: stocks, bonds, and mutual funds. Now, it can be really important to diversify among these so that you say don't have a 100% bond portfolio that can't really get that high of a return, or a 100% stock portfolio that has no guarantee of principal. We'll go over this and potential investment breakdowns by age in my next video. If you like this video, feel free to give it a thumbs up and subscribe if you haven't already. I'll see you in the next one.